When it comes to whole life insurance, cash value can be a somewhat confusing subject. So today, let's dive in and pick apart the pieces of what exactly cash value means when it comes to whole life insurance. Whole life insurance is known for a couple of different things. Guarantees are a pretty strong pillar of the product's identification, and cash value is something else that a lot of people get very excited about on the subject of whole life insurance. And specifically, we know or come to find out that whole life policies do have an element of guarantees in regard to their cash accumulation and the cash value that sits inside the policy. But what specifically that guarantee means is a little bit obtuse and quite confusing for a number of people, especially lay people. So we're going to explain exactly what the various cash value components are to a whole life policy. Now, the cash in a whole life policy really breaks down into two broad categories. You have guaranteed cash value, and then, of course, you have non-guaranteed cash value. The guaranteed cash value, or more specifically, the base guaranteed cash value, which I know is kind of a strange term, but it does mean something in the very esoteric world of insurance minutia that's not particularly important to most people, but there are some specific differentiators here, and it explains why insurance companies refer to certain pieces of a whole life's policy cash value as guaranteed and not other pieces of the cash value as being guaranteed, which can cause a considerable amount of confusion for people, especially when they're in the early years of policy ownership, because they kind of look at the policy as it's unfolding and they have some questions about why the company is calling a certain component guaranteed and a certain different component not guaranteed. And it causes some questions. So things to understand about the base guaranteed cash value of a whole life policy. First and foremost, this is the cash that accumulates that is attributable to the payment of the base premium of the whole life policy. So in a lot of cases, this is just the premium of the whole life policy. But you might find the term base premium thrown about either by us or other professionals in the industry, and it does mean something to us when we talk about it in that context. So the premium, and again, the base premium, which is kind of the more technical term that you pay, this looks something like you get $1 million death benefit and the insurance company tells you that you have to pay $14,000 per year for that $1 million of life insurance. That premium is the base whole life premium. Paying that premium gets you the guaranteed cash value that accumulates inside of a whole life policy. There's a couple of different things to understand in terms of the attributes of the guaranteed cash value or the base guaranteed cash value. This cash is guaranteed to equal the death benefit at the maturity of the policy. So for most people buying a policy these days, that's going to be age 120 for the insured. There are some older policies out there where this would be age 100, and even older policies still where that might be age 90. And if you're sitting on an endowment contract, which is not a modified endowment contract, but an endowment contract, which functions identically to whole life insurance, it just has a much sooner maturity date, the guaranteed cash in that would equal the initial death benefit of the endowment contract at that date, which is probably something like the insured's age 65. The guaranteed or base guaranteed cash value does not affect the death benefit of the whole life policy, at least not in terms that most individuals who buy a policy would take any note of. So what I mean by that is if you have $1 million whole life policy and it accumulates $5,000 of guaranteed cash value in any given year, that does not change the death benefit outstanding on the whole life policy. You have an additional $5,000 of guaranteed cash value, but you still have $1 million death benefit. That doesn't make any change to the outstanding death benefit. Lastly, you should understand that you cannot withdraw the cash, the guaranteed cash or base guaranteed cash from a whole life policy. So if you want to access that cash value, you must take a loan against it. The only other way to get access to it is to fully surrender the contract and release the cash from the whole life policy. So guaranteed base, guaranteed cash must be lent against. It cannot be withdrawn from the whole life contract. The non-guaranteed cash value that exists in a whole life insurance policy is created entirely by paid up additions. There are two ways you could get paid up additions into a policy. You could either electively put them there yourself, or you can get them through the dividend option to purchase paid up additions. The non-guaranteed cash value in a whole life policy will earn a guaranteed interest rate. This is the base guaranteed interest rate of the whole life policy. And it will also help earn dividends because paid up additions themselves earn dividends. The non-guaranteed cash value will also increase the death benefit outstanding on the whole life policy. Paid up additions, because they are the non-guaranteed cash aspect, have death benefits all on their own. So when you have non-guaranteed cash value on a whole life policy, you will see the death benefit increases over time. And in general, this death benefit is some multiple of whatever dollars went into the paid up addition or non-guaranteed cash. You can think of non-guaranteed cash and paid up addition as being the exact same thing. This might look something like a $5,000 increase in non-guaranteed cash value actually creating a $15,000 additional death benefit on top of your original base whole life death benefit. And lastly, you can withdraw non-guaranteed cash value from a whole life policy. You do not have to surrender the contract, and you do not have to take a loan against it if you do not want to. The process of doing this, technically speaking, is surrendering the paid up additions. That's the term that we would use inside the industry to talk about a withdrawal of non-guaranteed cash. So if you have a whole life policy that has earned dividends or one that has a paid up additions rider that you yourself have contributed to, and you call up the insurance company and tell them something like, hey, I'd like to withdraw $10,000 from my whole life policy, and they say something about surrendering dividends or surrendering paid up additions, they mean all the same thing. You are withdrawing money, and surrendering something from a whole life policy in terms of paid up additions or dividends is a withdrawal from a whole life insurance policy. Now, at the same time, you can take a loan against non-guaranteed cash value if you wish, and there's lots of times somebody would do that. So with the non-guaranteed cash, you have the option of either withdrawing or taking a loan against it. Now, earlier when I was talking about guaranteed cash value, I made references to base guaranteed cash value, and I said that was specific and important. The reason I said that is because technically, once cash value exists inside a whole life policy, it is technically from there forward guaranteed cash value. It will earn the guaranteed rate of return, and it will bolster the growth of guaranteed cash value outstanding on the whole life policy. This causes a lot of confusion because people assume that what they understood to be the case with base guaranteed cash value now applies to, I guess, all of the cash value. Or on top of that, if I look at my policy statement, why is it telling me that I have $50,000 of cash value, but I only have $8,000 of guaranteed cash value? Does that then mean that I have $42,000 of cash that is not guaranteed and could potentially go down in value? No, it doesn't mean that at all. So the insurance company is simply differentiating the base guaranteed cash value from the rest of the cash value, but understand that all of it is guaranteed. All of it will earn guaranteed interest, and all of it will, to some degree, at least in the sense of paid up additions, affect the payment of future non-guaranteed features, specifically dividends. Also understand that even though your paid up additions contributed, or what we're calling non-guaranteed cash value, is technically guaranteed moving forward, you can withdraw this money from the contract. So even though it is a guaranteed component of the policy, because it was created by paid up additions and kind of falls under the category of the non-guaranteed aspect of cash in the policy, it can be withdrawn. You do not have to take a loan against it if you don't want to. This does create an interesting circumstance, though, with regards to the functionality of whole life insurance over time, because the guarantee, at least so far as the cash value is concerned, does enhance when you put additional money into the contract via a paid up additions rider, or you earn a dividend that you use to then purchase paid up additions. What I want to do is look at a couple of whole life insurance ledgers to really quantify this point. So we have in front of us a basic whole life proposal, or what we sometimes refer to in the industry as an illustration. It has a $1 million death benefit, and the insured must pay $13,950 per year in order to satisfy the contractual requirements to maintain that $1 million death benefit. We have a guaranteed column of values. We have a non-guaranteed column of values, and we have cash value, that is guaranteed cash value, and we have total cash value, which shows us both the guaranteed plus non-guaranteed cash values added together. There is no elective paid up additions rider being used in this situation, so all of the non-guaranteed cash value that accumulates from here will be created by dividends that are used to purchase paid up additions. So I want to go out to year 10 and look at the cash value on the guaranteed side that's in there. $95,520 is the accumulated guaranteed cash value in the policy, and that has accumulated by virtue of the policyholder having paid the $13,950 in premium. Obviously, not all $13,950 goes towards the accumulation of guaranteed cash value. There are insurance expenses that are deducted from that $13,950, and what is left over accumulates guaranteed cash value. Over on the non-guaranteed side, we'll notice that there's $130,960 in accumulated cash value, which is more, quite considerably more, than the guaranteed cash value that has accumulated in the policy at this point. And the sole driving force behind that is the payment of dividends, which have then gone towards the purchase of paid up additions. So this difference between $139.60 and $95,520 is represented by paid up additions that have accumulated in the policy, and they are basically stacked on top of the on top of the guaranteed cash value that has also accumulated in the policy. So what this effectively means is the policyholder has accumulated $130,000 of cash value, and if they wanted to take money out of the policy, they could withdraw something in the order of like $35,000. But if they wanted more than that, they would need to take a loan against some value, because that $95,000 of guaranteed cash value cannot be withdrawn from the contract. So if they wanted to withdraw $20,000, they're fine. They have enough non-guaranteed cash value to do that. If they wanted to take, let's say, $100,000 from the policy, they would be able to withdraw about $30,000-ish or about $35,000. The rest of it would need to come to them as a loan. But as time goes on, the gap between non-guaranteed and guaranteed cash value is going to grow. If we go out to year 15, for example, we now have $169,000 or almost $170,000 in guaranteed cash value, but we have almost $254,000 of total cash value, a lot of which is non-guaranteed cash value. So we are seeing a gap grow between the guaranteed cash and the non-guaranteed cash. And that means we have greater capacity to withdraw money from the policy when we want to, or if we want to, versus just taking a loan. In addition to this, I want to go back to that guaranteed cash, or rather cash is all guaranteed moving forward concept that I brought up earlier. So again, even though the cash value that is created by paid up additions is not normally looked at from an accounting standpoint of a whole life policy as guaranteed cash value, primarily for the sake of differentiating it from base guaranteed cash value, which you can only take a loan against, you cannot withdraw. The fact still remains that the cash value, whether it comes from paid up addition sources or simply paying the base premium of the whole life policy, the more cash we have, the more that enhances the growth of guaranteed cash value in the policy. Again, we'll look at some ledgers of a real policy to show you exactly how that unfolds over time. So here we have the original illustration for a policy we've talked about on this channel before. This may look a little different than the ledgers that we've looked at on that policy because as time goes on, insurance companies might change the way that they report things. And so this output for the ledger looks a little different, but this is the original one. So this policy, I want to look at the guaranteed cash value again. And we can talk about the non-guaranteed cash value, but for this point, it's a little less exciting. I want to start by going to year 13 because we're going to look at the real in-force illustration in just a second, and we're in year 13 for that policy, so that's an important comparison to make here. If we look at the cash value, guaranteed cash value projections, when this policy was put in force, we'll see that the original assumption about guaranteed cash value accumulation was $70,529 by the time year 13 rolled around. But here's what really happened. We are now in year 13. It ends up that this particular policyholder didn't pay exactly the same amount that was assumed at inception, ended up paying more money than was originally assumed. But the guaranteed column now shows us $156,530 in guaranteed cash value. That's double, more than double, the original projection of guaranteed cash value. There are a couple things that are driving that. On the one hand, there's obviously the fact that the policyholder put more money into the policy than was originally assumed. That absolutely affects the accumulation of both guaranteed and non-guaranteed cash value. But other things are going on here. One, there's more dividends being paid than was assumed to be the case if the original lower amount of premium was all that was ever paid to the policy. This makes sense. You put in more money and you grow a larger base of cash. You are going to earn more dividends on that larger base of cash. So those additional dividends have driven up the actual cash performance. And like I said earlier, once cash exists in a whole life policy, it becomes the guaranteed cash value in the policy, and it enhances the growth of guaranteed cash value because the guaranteed rate does not change, but the guaranteed rate is being paid on a higher sum of money. Think of it this way. If the guaranteed rate on a whole life policy is 4%, and I do realize it doesn't work this simply, but just bear with me for this example because it'll make the numbers easier to understand. So if 4% is the interest rate accumulation, and we assume that 10 years into the future, we're going to have $100,000 of guaranteed cash value. That means guaranteed interest accumulation would be $4,000 on this $100,000 of guaranteed cash value. Well, if instead, 10 years later, we end up with $200,000 of cash value in the policy, which is all guaranteed cash value, technically speaking, that now means that the absolute amount of interest paid is not $4,000, it's $8,000. And that $8,000 payment of guaranteed interest is going to, forever and always moving forward, enhance the growth of guaranteed cash value in the policy. And to further prove my point on this, I want to look at year 30, age 56 of the insured. And again, look at the total cash value column. What we see is $216,538 being the projected guaranteed cash value in the policy. Now, we already know that come year 13, this $70,529 is wrong. The actual amount of guaranteed cash value in there is going to be, well, is double or a little more than double. Now, let's look at how this $216,538 compares to what the forward moving projection is when we look again at the in-force illustration. Now, in year 30, age 56, the guaranteed cash value projected is $468,019. You might be looking at those numbers and thinking, well, okay, yeah, it's higher, but we're also paying a much higher premium. But if we take the difference between the original plan premium, the $5,000, and the premium that was actually paid for the number of years from year 13 to year 30, what we end up with is an excess premium payment in aggregate of just over $72,000, $72,480 rather, I think is what it comes out to. The difference in cash value, guaranteed cash value, is over $250,000. The reason this is going up is not just the excess premium payment moving forward. It's absolutely the fact that we're getting the guaranteed interest rate compounded on a substantially larger number than was originally assumed. And keep in mind, because we're looking at the guaranteed ledger, this assumes that 0 dividends are being paid now from year 13 through the rest of the policy's existence. So it's not being driven by the assumption that future dividends will also enhance the cash value or the non-guaranteed cash value of the policy. It's purely a function of additional premium payments, which again only total $72,480, plus the guaranteed interest that will be earned on the policy moving forward. Now that the guaranteed cash that is accumulated in the policy is much, much larger than we originally assumed would be the case way back when the policy was issued 13 years ago. This is all a really important point to make, because something people kind of lose sight of when we look at projections for whole life insurance and we start to tweak the dividend assumption to say, well, what happens if the dividend goes down 25 basis points or 10 basis points or 50 basis points? That assumption is going to carry through for all the years moving forward. But that's not likely to happen. So if somebody gets to, let's say, age 65 with a whole life policy that they purchased with the intention of using the cash for an income source, and they're worried about what's going to happen to the dividend moving forward, that will have an impact on the cash value accumulation in the policy. But the actual impact on the cash value of the policy moving forward at that stage is substantially less than people realize, and it's significantly less than is modeled when we look at illustrations starting today and moving forward and making those dividend adjustment assumptions. This happens because the guaranteed accumulation, the guaranteed interest rate, which is applicable to all of the cash value in the policy, has a substantial impact on the performance of the policy moving forward at that point. Another way to say it that's probably a little bit simpler is changes in dividends later in life have a substantially less impactful move on cash value and what you can ultimately do with a whole life policy than you think, because guaranteed interest is still there and that cannot change. It's contractually guaranteed to do what it does. I know all of this may make whole life insurance seem a bit complicated and perhaps you don't want to deal with all this stuff. I get it. But trust me, there is gold to be unearthed when it comes to whole life insurance as a potential asset for your portfolio. And the best news is you don't really have to understand intimately all the pieces and parts. You just have to find somebody who understands those parts and can guide you. The really good news is we've been doing that for a very long time. So if you're interested, you could always reach out to us.